Do you know how much taxes you're paying if you're making $80,000 a year? Depending on the province you're in, you're paying anywhere from $19,000 to $21,000 in taxes every single year. That's a quarter of your earnings gone to the government before you even get to spend any of it or pay any bills with it. So it's important to keep up to date with the tax changes and how it might affect us. So we'll be going over the changes for 2024, including the major changes if you own real estate, TFSA, RSP, FHSA, income taxes, and the new trust reporting rules that are getting a lot of people anxious. So starting with the major stuff, there's a new rule for flipping residential real estate. And if you've made profits from selling a property that you've owned less than 365 days, then it will become fully taxable as business income. So that means there's no more principal residence exemption, and it also doesn't qualify as a capital gain, so you cannot use the 50% inclusion rate. This is the government's attempt to cool off the real estate market. Another change they're implementing to try to do this is that they're adding more restrictions to short-term rentals in cities like Vancouver, Toronto, or Montreal. And they would deny income tax deductions for any expenses related to short-term rentals. This is their way to try to push the units back onto the long-term rental market and ultimately ease the housing prices. And as for BC, there's actually two changes that will affect homeowners. The first one is the property flipping tax that will affect anyone who sells their house within 2 years of purchase. So there's going to be 20% tax if you sell your property within 1 year or 365 days. And after the first year, it will gradually decrease the tax rate until it hits zero after 2 years. So the BC government is really trying to stabilize the housing prices. And this is an additional tax on top of the federal taxes that we mentioned. The second change is the property transfer tax exemption. So effective April 1st, 2024, they're increasing the property transfer tax thresholds for first-time homeowners and also for newly built houses. So for first home buyers, it used to be $500,000, and now they've increased it to $860,000, which makes a lot more sense because properties in Vancouver are easily over $500,000. Then with the newly built homes, it will be increased from $750,000 to $1.15 million. So this will definitely help new homeowners save thousands of tax dollars. In terms of TFSA, the contribution limit has increased to $7,000 for 2024, with unused contributions accumulating for future use. Depending on which year you're born or which year you immigrated to Canada, your maximum contribution room might be different. So let's take a look at this table to see where you're at. As we can see here, if you're 33 or older, then you would already have the maximum $95,000 of contribution room. Now, let's say if you're only 25 years old or you're born in 1999, then your maximum contribution room would only be $47,000. As for new immigrants, we can see that it depends on your year of arrival. So if you arrived 2009 or earlier, then you would already have the maximum contribution room. However, if you've only recently immigrated here or you arrived, let's say, for example, in 2020, then your contribution room would only be $31,500. So this is just a quick reference guide on how much is your maximum contribution room. But if you want a more accurate number that accounts for your previous contributions, then you can check that by logging into your CRA My account. So if you're investing your money, take advantage of this account to grow it tax-free. And the TFSA is also the most flexible account out of the other registered accounts like RSP or FHSA, because you can withdraw money from this account for any purpose, tax-free. In terms of RSPs, the contribution limit has always been 18% of your last year's earned income. And for 2024, it is now capped at $31,560. That being said, this cap only really applies to high-income earners that are making over $175,000 of income. Now, the reason why people use the RSPs is because contributions give us a tax deduction to lower our income taxes, which means you save more taxes, leading to a bigger tax refund. Also, the growth inside RSP is tax deferred, which is just a fancy way to say that it's tax-free now, but it will be taxed later when you withdraw money out from it. So this account is really designed to help you save taxes during your working years when you're earning higher income. Then when you withdraw from it during your lower income years, which is typically your retirement, then you get taxed at a much lower tax bracket. There is two exceptions to this though, where you can withdraw tax-free. The first one being the home buyer's plan, where you're using the money to buy your first home. And the second is the lifelong learning plan, where you're studying full time. So even if saving for retirement is not your thing right now, if you're looking to buy your first home or going back to study full time soon, then RSP might still be a great option for you to consider. The deadline for contributing into RSP for the 2023 taxation year is February 29th of 2024. So the government does give us some time to run our calculations and see how much income that we've earned in the full year before deciding if we want to buy RSPs or not. But keep in mind though that there are hefty penalties for over contributions. So before making any contributions, make sure you check your RSP contribution room, which you can do by simply logging into your CRMI account. Then there's the First Home Savings Account, or the FHSA. This is a new account that just became available in 2023, and it combines the benefits of TFSA and RSP for the purpose of your first home purchase. So when you contribute money into the FHSA, it gives you tax deductions just like the RSP. Then it grows inside tax-free as well. And when it comes time to withdraw for your first home purchase, you can withdraw everything out tax-free, just like the TFSA. There's also no requirement to make repayments after withdrawing the funds, unlike the RSP home buyer's plan. The contribution limit is $8,000 per year, or $40,000 lifetime limit. So this means it does take us 5 years to accumulate the maximum contribution room. But if you don't use up the whole $8,000 room in any given year, you are allowed to carry forward up to $8,000 for future years' contributions. Now let's get into the income taxes. Tax rates in each bracket remains the same for 2024, but the tax brackets have adjusted upward, which means if we make the same amount of income this year compared to last year, then we're actually paying slightly less taxes because more of our income is being included into the lower income brackets. CPP contributions also remain the same at 5.95%, but there is now a new additional CPP contribution for higher income earners. So if you're making more than $68,500 in 2024, then you will need to pay around $300 more in CPP contributions. As for the basic personal amount tax credit that's available for all Canadian tax residents, it has now increased to $15,705. So this means any income that you make below this $15,000 mark is basically tax-free. Moving on to the not so good news for income taxes is that there's no more simplified flat rate method, which is the $500 deduction that we got for home office expenses. This is no longer available for 2024. And if you owe any taxes to the government, the interest rate on late tax payments has now increased to 10% a year. Finally, there's a new requirement for trust reporting. So if you own a joint property with your child or with a parent that has a value of over $50,000 at any time in the year, then you'll want to pay attention to this. Now, before you dismiss this by saying, hey, I never signed anything at the lawyer's office or set up a trust account, you need to know that there is something called a bare trust. And this is a type of trust that you can unknowingly enter into without ever signing anything. And if you're part of a bare trust, then you would be required to file the trust income tax return, even if there was no income or any activity in the trust account. The deadline to file this trust tax return is April 2nd of 2024, and it has hefty penalties for late filing, which is the greater of $2,500 or 5% of the fair market value of your property. So let me explain to you what a bare trust is. Now, this is the official definition of a bare trust, but I'm not even going to read it out to you because it's just long and confusing. But simply put, if I ever have an asset and I transfer some or all of it to another person, but that person cannot act or make any decision on the asset unless I specifically give them instruction to, then this is considered a bare trust. So some common examples of when it would be considered a bare trust. Number one is when a parent co-signs a mortgage for a child trying to qualify for their mortgage. Number two is when there's an aging parent putting their kid's name as partial owners of the house to avoid paying probate fees. And number three is joint accounts between parent and child with over $50,000. So if you're in a situation similar to this and you're not sure if you are in a bare trust, be sure to consult with a CPA to see if you're required to file the trust income tax return. Now, there are some solutions to the above scenarios. For example, if you have some assets that you want to give someone else easier access to, then you can consider setting up something called the power of attorney. And if you're a parent trying to help your child qualify for the mortgage, instead of being a co-signer and becoming a partial owner, you can actually become the guarantor. So the parent's name does not need to be included on the property title. And if you want to dive deeper into the workings of the RSP, check out our video on the 6 RSP mistakes you must avoid. And I'll see you in the next one.